What is up, YouTube? What is up, guys? The Composer Trader here, and welcome back to another video here on my channel. And it is the first video in 2025. So I want to start off with saying I hope you all had a blessed new year, got some time in with your family, your loved ones, your friends, had a mental reset, wrote down your goals for 2025, and are just in a great state of mind to absolutely kill it this year. Because trust me, 2025 is going to be even crazier than 2024. And the market makers were like, you know what? Let's confirm that by just in the first full trading week of the year, give the most insane PO3 short setup that I have seen in a while. Not only that, the market makers decided to give you such an insane short setup, such a textbook PO3 schematic, 2 weeks after I released my new lecture number 8, to the TCT mentorship that you can find on my YouTube on this channel underneath the playlist section. Just 2 weeks after I've released that lecture, telling you everything you need to know about PO3s, everything you need to know to trade this PO3, and we got the most textbook model I have seen in a while. It's absolutely insane. Okay, it's absolutely insane. So we're gonna dive deep into how you could have taken this trade. We will be using the concepts from the mentorship, obviously, and especially from the lecture. So if you want to know everything in detail about a PO3, then you can go to the TCT mentorship, go to lecture 8. You can see it right here. It's on my channel, lecture 8, PO3 schematics. Okay, uploaded 2 weeks ago. Markets were like, you know what? Let's just give a textbook schematic. So enough talking. Let's just dive straight into the charts. Okay. Let's get rid of this. We can also get rid of everything low key. Okay, let's start. So, as always, I like to build some context, okay? And from a context perspective, the only thing you need to know on ETH is that we actually already had, now that I'm looking at it, we had a high time frame PO3 schematic where we had the range, we had the manipulation right here, and then we had the expansion, and that completed itself, okay? So we already had a high time frame macro PO3 with the range, with the manipulation, with the expansion, where the manipulation phase was way hard to trade because you never took that initial low, and you also didn't really have a proper accumulation inside of this manipulation phase. So a bit harder to trade, but it did play out. And it hit the technical target, okay? I always say the technical target is not a random target at 5K, 5 to 7K. No, it is the initial range high. So this PO3 completed itself, hitting the range high, and from there, we actually sold off aggressively. So now let's just get rid of that entire PO3 idea and then just look at this entire range in general, okay? From a context perspective, we have a range going on. We swept the range high right here, and from there, sold off very aggressively, actually breaking structure from the low up back to bearish right here, making higher lows and higher highs following the 6 candle rule, not on the daily time frame, but definitely on the 18-hour time frame, as you can see right here. Let's make that a bit thicker. So we swept the range high, completing the PO3, hitting a technical target, and then we broke structure back to bearish. So when you sweep the range high and you break high time frame structure back to bearish, and you get a retracement, and you are located in premium pricing, which you are, almost extreme premium pricing, from a context perspective, it is not weird to look for a potential short. So many people get trapped into this, oh, you know, it's Q1. Q1 is supposed to be bullish. January is supposed to be bullish. Those are just all narratives to trap you into thinking that a PO3 like we just had cannot play out. You know, you'll see the schematic, you'll see the confirmation, but you don't want to believe it, causing you to not trade it because you get misled by external news, okay? I'm telling you, news is just there to manipulate you, okay? You need to trade the data that's given to you, and just looking at this, you're in premium pricing after sweeping the range high, breaking market structure back to bearish, and overall, this PO3 schematic can complete itself, and you can still get a bullish Jan. We're talking about the first week in Jan, you know? It can complete itself, go over in an accumulation, and reverse back up if it wants to. So that's basically all that you need to know about the context. Okay, we're in premium pricing, so we can literally look for potential shorts. if we get confirmations, obviously. Now, if we follow our local structure from top to bottom, we can see that we were making lower highs and lower lows, just like this. And when we're trending down, we can pull our range from bottom to top. But what you guys can't forget, and I see this mistake getting made pretty often actually, is that yes, you're trending down from top to bottom, so you can pull your range like this. But if you look closely, there's barely any price action in the lower section of the range. And you have multiple levels of market structure. And you can also pull your range from bottom to top. That's making a higher low for a potential higher high, right? Now, at that point in time, it did not make the new higher high. But we know if we're locally from bottom to top, from this bottom to that top, we're trending up, we can pull our range from top to bottom. And when we get a move back to the equilibrium, that confirms your range. And looking at this range is actually way cleaner to use than to use the range from this low, because there's just simply no price action in here, right? This is the actual range where price went from discount to premium and hovered around that EQ for some time, okay? So this was the better range to use and also the correct range to use when looking at your PO3s. So we have this current range going on, okay? We have this current range going on. Now, what was price doing inside of the range? As we can see, if we look at the high and the low, the highs and the lows of the range were never taken. And actually, if we look closely, we can see that price is actually compressing inside of the range, where right here, if we draw these liquidity curves, we can see that price is slowly making lower highs within the range and higher lows, compressing into one point where right here for over 6 days, price was barely budging, barely doing anything. And then we aggressively broke towards the upside, okay? Now, if you have paid attention, okay, to the lecture 8 of the TCT mentorship where I talk about PO3 schematics, I actually say right here, range requirements. In order to have a valid PO3 within your range, you need to have either a good return to zone building up, and this can be through the creation of a liquidity curve or a liquidity trend line. And here, quote unquote, it is even better if you have price compressing within the range, building liquidity on both sides, right? So as you can see, it's even better if you are compressing within the range, and we were compressing within the range. And then what followed? An aggressive push towards the upside. And I also say in the video, the more aggressive that you push towards the upside, the better it is for a potential PO3. So the moment I saw price breaking out aggressively here, immediately, instead of becoming bullish, your alarm bells of a potential PO3 should be ringing, okay? You should immediately think of, oh my God, we could be putting in a potential PO3. And it's a complete shift in mindset, because people will look at this and we never had the proper accumulation. So how are the market makers going to push price aggressively higher if Bitcoin and ETH never had a proper accumulation pushing out here? Okay? Think about that. People are like, oh yeah, we're just going to do this curvature up effect. No, they didn't have enough opportunity to sweep a lot of sell side liquidity to fill massive longs that can cause us to break out. So we had this range, we were compressing, and then we were breaking out. Okay? Breaking out aggressively, which is even better for a potential PO3. So the range was meeting all the requirements, okay? The range was meeting all the requirements of a potential PO3. Now we need to look at the manipulation phase, because we need a valid distribution model in the manipulation phase to confirm an entry, and then we need an aggressive close back inside to confirm the PO3. It's a multiple step process trade, okay? So looking at what happened, also as we can see right here, we were drawing that structure from top to bottom earlier. Right here was your market structure high that you actually ended up sweeping. And right here, we also had a 4-hour supply zone. Okay. So initially, zooming in on that manipulation range, as we can see right here, price was trending out of our range. Okay, price was trending out of our range. And then from there, we were making a higher low and a higher high just like this. Okay, now when we're making higher lows and higher highs, pushing out of our range, we're in a local uptrend. So we pull our range from top to bottom. And then right here, we can see a potential 1 tap. We can see a potential 2 tap. And then right here, we can see a potential 3 tap. Okay, so we can see our range high. We can see our range low. We can see the deviation 1. And then we came back up. Now, you might wonder, why is this not a 4 tap right here? That is because in order to validate a tap on the 30-minute time frame, you need to have the 6 candle rule in between deviations. So right here, we can say 2 candles up, 2 candles down, 2 candles up. Valid 1 and 2 tap. Right here, 2 candles down, 2 candles up. Valid. But we have 2 candles down, but we don't have the 2 consecutive bullish closing candles up. So this cannot be a deviation, and therefore we extend it to that high. That does have it, okay? So that's why you ignore that high. And this is a concept explained also in the mentorship where I talk about low time frame TCT schematics going over into high time frame TCT schematics. Now, initially, I actually looked at this first from a market structure perspective, and I drew my range from top to bottom from that second tap high right here. Why? Simply because this didn't have a proper return to zone building up from the start. You can see right here that we actually had this sell to buy that left behind demand right here. That price ended up bouncing from, and then only from that point on the lower time frame right here, we could see price building up some nice liquidity towards the downside right here. Okay, where this basically represents all these lows that are stacking up to be higher lows, okay? Not leaving behind any proper demand. You can see all these lows are stacking up very nicely, a bit more sharp, but still valid. So the liquidity curve represents all these higher lows stacking up where people that are longing inside of this range put their stop loss below the previous swing point, which are going to be these lows that you're seeing on the chart. So the moment a low like that gets triggered, it causes the stop loss to get mitigated, which causes a sell order, because if you're longing and your stop loss gets triggered, that causes a sell order, and then you can get this liquidation cascade down. Okay? Now, when we are trading at PO3, our entry is simply on the distribution model in this case, because we're talking about a bearish PO3, okay, is simply on the confirmation of the distribution model. And then the key with doing this is that even though you short the distribution model that maybe doesn't go over in the PO3 that you were hoping for, the moment price hits that range low, you should still be de-risking your setup. Meaning you take profit, which the profit amount equals out your stop loss amount. So you have a risk-free trade. So by that time, your distribution completed itself because the technical target of the distribution is the range low. And if you get the follow through, it's just an extra benefit. If not, you have a risk-free trade and you can get stopped at break even. Or if it turns into an accumulation, you can just simply take profit or hedge long. But that's absolutely crucial to understand. We don't enter on the break back inside because that needs to be aggressive. And if it's aggressive, the risk to reward is not going to be worth it. We're going to try and find a short in the distribution model like we always do, because that's a requirement for the PO3. And if we get the breakdown, it's extra. And this also allows us to get a very good risk to reward. So right here, we created that model 1 distribution. We had to return to zone, and then we broke market structure back to bearish right here. Okay, so right there was my initial entry. Stop loss goes above the third tap high. Nothing different with that. Just simply trading a distribution model. Technical target of the distribution is a 2.1 risk to reward to the range low. But obviously, we are not looking to fully cash out at the range low. No, we are looking to cash out lower. Okay. Now, as you can see right here is that this initial idea did not play out. So what happened is that price went to the range low, hit our technical target, allowing you to de-risk your position, okay? But then we reversed back up because we took that range low ever so slightly, and then we broke structure from top to bottom right here back to bullish, okay? So we broke it right here back to bullish. So then expectational order flow would be a higher low for a higher high, which is then what we got, okay? Now, right here, your trade should be de-risked, okay? Your trade should be de-risked. There's no reason for you to risk any more money on this setup, okay? Especially, you don't want price coming back up all the way because you came down leaving liquidity and not that obvious looking resistance. You did have one supply zone up here, okay, right in that third tab, which could give the possibility of this model 1 distribution going over in a model 2 distribution right here, where you sweep extreme liquidity and mitigate supply. And this also actually broke lower because it broke structure back to bearish after putting in that tab right here on the low time frame. Right there. Broke structure back to bearish. And at that point in time, from a liquidity and a supply perspective, and people ask me this all the time, Lars, when do you trail your stop loss? When is it valid to trail? When do you have to keep it above your original starting point? If there's no reason to go higher from a liquidity and a supply perspective above a certain point, because we're trading a distribution right now, that becomes your new invalidation. So if my entry is here and price is right here, I cannot move my stop to break even because price can come up, sweep that liquidity and supply. There are reasons to come higher from a liquidity and supply perspective and still go down. But the moment we sweep all that liquidity, mitigate that supply, and break structure back to bearish, there should be no reason to come above this point because there's no resistance above that point. So price, if price is going to come above that point, it's most certainly also going to come above this point. And this was my initial invalidation. But now I know if we go above that point, we're going to go to that point, causing the invalidation to shift towards that new high. So if you could have taken a TP right here, and if you didn't, your entry is right here. You could have trailed your stop loss down from here all the way to here, allowing you to only risk like 0.2 to 0.3% of your initial risk size, which is absolutely nothing if you're usually risking 1%. So definitely you should not have lost any money on that setup, okay? Now, whenever this pushed higher, which happened during Asia, and I was not awake for this, I started to realize something that I zoomed out and I was like, but on the 4 hour, okay, on the 4 hour, instead of just looking at this tiny range right here, which was a valid model 1, we have the opportunity, if I delete all of this, that following my structure, we have 4-hour market structure right here. And even though this low time frame distribution, where I was more focused on the distribution from that 3 drive on that second tab on the higher time frame itself right here, I was more focused on that 3 tab, but it doesn't mean that this was also technically a valid 3 tab. I just like to look at mine more because of the V-shaped recovery in that pivot point, leaving behind demand and the true return to zone starting from my point. Now that we went higher again, I'm like, oh, but this could actually then turn into a 3 drive, a TCT Model 1 distribution on the 4 hour, where we actually use this as my range starting point, which immediately makes it even better looking because you just have a picture perfect range formation, okay? You have a picture perfect range formation right here, and we're talking exactly about that point in time above that initial range right here. So this is what I drew at that point in time. It's a perfect range that looks like a perfect TCT Model 1 distribution, leaving behind all these lows, and we're going to get into the setup on the lower time frame in a second. But just looking at it from a PO3 standpoint, the moment we took that high one more time, and I was realizing that this is also a 4-hour range and a valid 4-hour distribution. If we could break structure right there, I was like, okay, this is 100% gonna dump back down. Like the moment we put in that tap, I was very convinced, because you have a picture perfect range that has a picture perfect Wyckoff Model 1 distribution, where you have a picture perfect initial range that was compressing, a push out perfectly. It was checking off all the boxes that I've given to you in the TCT mentorship lecture 8 about PO3 schematics. But you can see that something trickier even happened. So we're going to dive into that, okay? Because like I said, this was a bit more of an advanced entry. Now, the moment we took it high one more time, I switched my perspective, starting this is my point, like I just shown you on the 4-hour. And I know, obviously, we had this distribution right here on the 30-minute, where I looked at this one, but I knew low time frame schematics can go over in high time frame schematics, and this right here is simply one model 1 distribution on the 4-hour. Okay? So now there's nothing else to do than to simply look for another break of structure after putting in that tap, right? So we're going to go on the lower time frame right here. And as we can see, I was looking for literally the most local structure break that you could have gotten back inside your range. So looking at the most local structure, we can see this is the most local push up that was making higher lows and higher highs coming into that third tap. And right here, we broke that back to bearish. It's that simple, guys. I was just looking for the most local break of structure back below your original range high, which is this black horizontal line. So this is where the short gets triggered. Okay, this is where the shorts gets triggered. Our new short opportunity. Stop loss again goes above that third tap, and then we target the macro low right here for a 1 to 13 risk to reward. Beauty of a setup. There was only one issue. Even though the lows were curving up to be extremely nice, we had one demand zone, actually two demand zones in our way. Okay. We had a 45-minute demand zone right here. You can see this 45-minute order block. And we have this 30-minute pivot point block right here. So we had two demand zones that were holding and that could potentially stop price from sweeping those lows that were building up to be so nice. And therefore also stopping the distribution from playing out. Now, obviously, you're already seeing the aftermath, but let me show you how you could have trade managed this perfectly so you were still not to lose any money on this initial short. Because I did shorted this break of structure right here with my stop loss above the high, but something crucial happened. Because if you pay close attention, okay, if you pay close attention, right here, price came down breaking market structure, okay? We created structure supply right there. Where for the structure supply, I'm basically using this move up that broke structure as well, leaving an inefficiency. It's the same as an order block. I'm just using multiple candles going up and multiple candles going down instead of just two candles, okay? Now, price came in here, mitigated the supply, and then went lower. But it went lower extremely slow, okay? You can see coming into that support POI, price was leaving a massive buy side liquidity trail. And as I always say, the slower that you come down, the more bullish that actually is. However, let me give you guys a little secret tip regarding perfect taps, because we left behind supply here, but we literally right here had a perfect tap. We tapped it to the dollar. Anytime that you have a perfect tap of supply, price likes to come back to take out that tap, sweep it, and then dump back down. So whenever I saw this accumulation right here, because we did have this 1, this 2, which is a low time frame model 2 accumulation schematic, I thought to myself, okay, can I move my stop loss to break even? Like, can I actually move my stop loss to break even? No, because there's a reason to go higher, to take out that perfect tap and then potentially dump back down, getting a deeper mitigation of this supply zone. So I kept my stop loss the same, and then price went up, got a deeper mitigation into the supply zone, wicked that initial perfect tap, and then broke market structure back to bearish. Okay, right there, broke market structure back to bearish. So now I'm like, okay, we had a deeper mitigation into supply. We broke market structure back to bearish. This needs to go. Okay, we do have a 30-minute demand zone that could hold us up, but I want this to maybe get a slight bounce off the demand and then just go down. And I was also saying this live on stream. Okay, we need to go down. If we start wicking the low, we're going to have a problem. Now, looking at what happened, if we zoom back out again, you can see what was price doing. We're expecting a potential PO3. We're expecting a potential very aggressive expansion towards the downside. However, ever since our first low that got put in, our first lower high, lower low after breaking structure right here, following this low time frame break of structure, ever since our first lower high, lower low, price did nothing but wicking the low. Wicking the low once, wicking the low twice, and wicking the low 3 times. So on my private live stream during New York OPA, where in the Discord I always go live for New York OPA to catch live trades and to talk about price action, I told them, and I told the team, I was like, we're wicking the low over and over again. So what are the market makers doing right here? If you're wicking the low over again, leaving the highs intact. If you can break the low, it's very simple, guys. You can compare it to soccer. I always say this. If you can score in one goal, you're going to score in the other. If you can break the low, you're going to take the high. That's how it works, okay? Because this basically means that you're loading yourself up on longs, sweeping low over and over again to have an expansion back up. So the moment we SFP'd and started coming up here, that's not what you want to see. You know, that's not what you want to see. So there's no reason to go back above this point again from a liquidity or a supply perspective, because this got a deeper mitigation into supply and this actually took liquidity. So there's no reason to go higher. If you exceed this point, you're going to come to that point. Therefore making this your new invalidation, just like we did before. And that's why the moment we started wicking this low, when we came back up, your stop loss from this high could have been trailed to that high, and the entry is here. In other words, your stop loss is entry. Okay? And then price swept and came back up again. Okay? Price came back up again. So, now we're here with a trade where we got stopped out twice at break even, not losing any money. But we're like, man, it still has that perfect range. So I was like, okay, what's going to happen next? Now, we had that market structure high right there, but we didn't just have that market structure high. We actually also had a secret little level. As you can see right here, using the candle body closes, we can see this bearish order block that got ran through once with an inefficiency and then ran through twice, kind of calling this a double breaker block, okay? And that is also exactly the level. They tend to work very well when you use breakers from candle body closes that get ran through multiple times, leaving fair value gaps, because it just shows kind of like a hidden liquidity level, okay? So someone in the Discord actually mentioned this, pointed this out. Shout out to you. And I was just looking at it more from an SFP perspective, from the market structure high, but this is a very nice confluence. And the moment we went higher, we got a very sharp rejection from that hidden level. And I zoomed back out again. Like I saw the push up, I saw the harsh rejection. You can see that same candle we sold off very aggressively. And I look back on the 4-hour and I'm looking at it. And even though we already had 2 potential entries that got stopped at break even, I'm like, this can still be a Model 1 distribution schematic on the 4-hour. Why? I just told you, in order to have a valid deviation on a certain time frame, you need the 6 candle rule in between the taps. And our initial entry right here never had 2 consecutive candles going down. Therefore, not making this your deviation and just making this one push up. And this is explained in more depth in, I think, lecture 5B of the TCT mentorship, where I talk about advanced. It could also be 6, just advanced TCT schematics. Let me check. Lecture 6, yeah. Going over advanced TCT schematics. So it's lecture 6. So I'm like, oh man, it can still be a potential Model 1 distribution. And we're still building up the liquidity. Matter of fact, guys, we have now mitigated all that demand. Right? We have now mitigated all demand right here that could have held price up. And even though we had a potential demand zone, it wasn't that significant. It already got mitigated on the immediate push down, right? Right there, it got mitigated on the immediate push down. So this is also where, trading psychology plays a big role, because a lot of traders, they'll give up on an idea after getting stopped twice at break even, but you need to stay sharp. Okay, you need to stay sharp, because I knew this could be a potential generational short, which it ended up being. Now, zooming in, we came up so aggressively, right? We came up so aggressively that there was almost no structure to confirm an entry. It may seem very tempting, guys. It may seem very tempting to use this as your market structure low back inside the range, because this market structure doesn't matter right here. Okay, that market structure doesn't matter simply because that's outside your original range. You want a market structure break back below that range high. Okay. And this is actually not your market structure low that you can be watching, because the market structure from the low up is actually this. And every bit of price action in between these 2 points, which are your high and your low, is range price action. Okay, so that doesn't matter for your structure. So your market structure low was actually here, your proper market structure low. And then, price broke that, but we had demand right below it. So I wasn't gonna short right on the break of structure, because you're shorting literally into demand after already having an aggressive sell. So you can expect a bit of some relief up. But I was like, okay, if I get a confirmation to short back on the move up, I'll take it. Okay, I'll take it. So we did have a break of structure here. Obviously, after breaking structure, your expectational order flow is a lower high for a lower low, but you're only going to be putting in that lower high for the lower low if you break your market structure from the low up of the retracement, of the retest, right? Which is something like this, represented in blue. Your level 1 and your level 2 market structure, also explained in lecture 1. So I was watching this price action slowly grinding up, and I was like, hey, does this seem familiar? Right? Does this seem familiar? I'm on the 3-minute time frame right now, and what I'm seeing is a push up and a push down, a push up and a push down, and another push up. This right here that took the high initially is not valid market structure, because you didn't have the 2 consecutive bearish closing candles coming down. Okay, so I'm seeing 3 pushes up. I'm seeing a local uptrend. I'm pulling my range, therefore, from high to low. I'm seeing a tab 1. I'm seeing a tab 2, because this is 1 move up because of the lack of 6 candle rule between the deviations. And I'm seeing a tab 3. So I'm like, there is the possibility that we are right now getting that retracement. We had a very aggressive buy to sell, so I don't want to see price coming to any 618 retracement levels. No, you don't want to go back above that range again. You had a very aggressive buy to sell. Now you need to see the follow through. Now you don't want to get acceptance outside of the range to then immediately go higher. Okay, you need to reject right here. You needed to, in order to have bearish price action. I'm seeing the potential Model 1 redistribution now inside of a potential confirmed distribution, TCT within TCT. So I was looking for like, oh my God, we might have a crazy risk to reward setup building up. Now, looking at this low to that high, there was no market structure to confirm the distribution locally right here. Okay, there just wasn't. There simply wasn't. So what I simply did is, looking at the level 1 and the level 2 market structure, I waited for this market structure break. Now, obviously, looking at this low time frame distribution, that's a very bad risk to reward. But as you guys know, we're not we're not targeting, okay? We're not targeting the low time frame distribution. We're actually targeting the range low of your PO3, right? Which is around a 24 RR setup. You risk $100, you make 2.4K. You risk 1,000, you make 24 grand. Okay? So right here, when I saw this redistribution at a key POI, because she couldn't go back above that initial range high again, I shorted the markets. I shorted ETH. Okay? I shorted ETH with good size. Okay? I stayed around my 1% risk, but I exceeded a little bit just because it was a generational entry where everything was aligning. Okay? Now, I go a bet around 12. So right here, price was coming down, but it was kind of cooling off. You know, overall, entering around 930 is not something I usually do. Okay, it's not something I usually do because, you know, the volatility slows down around 10, 11, 12. Kind of have after hours, and then Asia can, you know, stop you out. I can't manage the trade because I'm not online. So I don't like to do it, but obviously I will make an exception for potential massive opportunities in the market. And right here at 12, I went to bed. I had my stop loss in place, and I woke up around 7 right here. So personally, bro, I was so stressed. I was like, if MEXC, because I'm trading on MEXC, right? And I'm also actually testing out a new trading exchange, but the chart was on Bybit. I was like, just imagine MEXC actually did this and kicked me out, you know? But MEXC luckily did not do that. I was still in the position. A bit of sketchy price action that I would not have liked seeing this in a live trading environment, especially price coming this close. But overall, we have our entry, we have our invalidation, and all there's left to do for us is simply stick to the plan. So, you know, price pushed down, but we came down very aggressive, or we came down very slow. Okay, so right here, we came down extremely slow, which is not something that you initially like if you're in it because you want to see a more aggressive push down. But we now have our entry. Okay, we now have our entry, and the technical target is the range low. This distribution does not confirm the PO3. It simply confirms our entry. What confirms the PO3 is getting an aggressive pop back inside. So the same way we popped out right here with an aggressive pop and an aggressive push up, the same way you want to see an aggressive push down. If you get that aggressive push down, that's when you're like, okay, the PO3 is going to happen. I can target the range low of the PO3. Simple as that. Okay. So I still had a limit order to de-risk my position at the technical target, which is the range low. Hence why I also took and realized a 15 RR trade when the original risk to reward is 24. Looking back, I should have gotten rid of that limit order, but the move down right here happened so fast that I had no time to cancel my limit order that was already right here. Okay, but that's the reason why I realized 15 instead of 24, because I couldn't move my stop to break even because like you're leaving a buy side liquidity trail, so there are reasons to come back up before potentially coming back down. Like price could have easily done this and kind of, you know, got a model 1 into a model 2. So right here, you know, you're up around 6%. So you take a certain percentage. I forgot how much it exactly was to de-risk the position, and then you leave the rest open. But that cost me to get around a 15 plus RR instead of a 24. Okay, and another key takeaway: the moment we got that pop back inside, that confirmed our PO3. You know, at that point in time, we're like, okay, yeah, that redistribution is going to be a legendary entry. This is confirmed as the manipulation phase, and now we can get the expansion down towards the range low. But a key takeaway as well, what I've also mentioned inside of the mentorship, and let's see if we can actually quickly find it right here. Boom, there it is. Regarding the expansion details, you can see this is the case of a bullish PO3, but you can see me drawing out a supply zone. You can say this is where a lot of retail get trapped, expecting a lower high following the overall trend. So what people will do is they'll use this point and they'll say lower high or high, low, lower high, lower low, lower high, and they're targeting for a lower low in that supply zone, which probably ends up or lining up with like a Fibonacci that they have or whatever retail uses. Now, if you turn this around in case of a bearish PO3, I'm talking about a potential demand that people try to long. So right here, we actually also had that picture perfect demand zone. This is not something that you should be worried about. There's actually something that's even more bearish because this is what makes people think of like, okay, following the overall structure, we're going to get a higher low and a higher high where people don't understand range deviations and PO3 schematics, okay? So from there, we're simply in a trade. We come down very aggressively, confirming the PO3, and then there's nothing else to do than letting the trade play out. And from there, we had an insanely fast move down. Like the move down was very fast. Boom. There you go. TP hit. I still have around 10% of the position open to take towards this low in case we ever come there. But it was absolutely picture perfect, guys. As you can see, it took us some time to go over it. The distribution in the manipulation phase was a bit tougher because you had a low time frame distribution right here, where I focus on an even lower time frame one that went over in a higher time frame one that went over into another higher time frame one. So this just goes to show that even though your initial entry might get stopped out, that doesn't mean that your exact idea and your exact plan and your pre-planning was wrong. It might mean that, the market makers just need a bit more liquidity and a bit more manipulation before actually completing your initial idea. So if you get stopped out on the move, don't immediately give up on it, okay? Keep paying close attention, accept the loss. As long as you stuck to your rules and you stuck to the plan while being in the trade, that's all good, okay? Because over time, you'll make a lot of money. And looking back, this could have been a 1 to 24. So taking like two break-even trades or two tiny losses because of good trade management, followed by the third trade that's a 24 RR, I'll take that exchange any day of the week, okay? So guys, make sure to always stay unbiased. Look at the chart objectively. It was all there. People were calling for a parabolic move up. That's just hoping. That's back with zero data. Zero. I told you all the rules for the PO3, and we got every single one of them. We got the range that was compressing. We got the pop back out. We got the demand creation to trap retail. We got the distribution and manipulation phase. And we got the pop back in. What else do you want? Okay, it's all there. It's in the mentorship. I appreciate every single one for watching. And if you want to see me trade live, you can find me inside of the TCT trading community. A link will be in the bio. And I see you all in the next one. Peace out.